Michael, welcome back. It's great to have you here.
Here, and I
You
come
are
for your
here,
singing
Michael.
every day. I come for your singing, Dal.
Yeah, I know, but that's
I
why
thought
I'm
he was going to
keeping
say,
my,
"I'm coming for your children."
well, I'm
No.
keeping my day job, Michael.
No,
And,
we won't do the Zuck Musk brawl in the Coliseum as I see being planned. So
all right. So what's top of mind for you, buddy, after, we haven't talked in a while? I know that you've been looking for higher yields. I follow you. I see your stream, and this move higher in yields doesn't surprise you. And I even recall our last interview where I thought maybe the bonds could come out of here for, bear market rally. And you said that you believed it was wave 4 and new lows were coming. And
yeah,
we're almost there. So nice call on that.
thank you.
Anything you want to show? Share your screen and show anything, or what?
So
I could bounce around.
I'll share my screen with you right now. I'm doing this from outside this morning because there's a lot of things going on in my house, and
Okay.
but let me share my screen with you.
Okay.
So I don't know. The things that's really has caught my attention quite a bit more recently is this Canadian dollar. I know you guys were just talking about it a little bit.
Yeah.
And specifically, like what I'm focused on right now is, what looks to be like a diamond reversal bottom here.
Okay.
And the potential for it to maybe get back to this 136 area in this area.
Okay.
You can see we've been consolidating some in here. Now, the reason why I'm focused on it is because it has this, I don't know, maybe you can tell me why, it has this amazing relationship with the VIX.
I never looked at the correlation, but I know when the USDCAD goes up, usually during risk off. So
Exactly. And that's
like
what
the dollar does. Okay.
Exactly. And you can see the relationship here is pretty amazing, and it's been particularly strong. And why this has my interest is because obviously, we've seen the S&P 500 sort of, as you mentioned, just sitting on this.
I'm looking for the March highs in Canada eventually.
Yes,
so
that's
does
what
does that mean that the VIX will get back to the March highs?
And that's what I'm equating this to, right? Is that
okay?
We get back to, which is basically, this is May, so March would be here.
Yeah.
I mean, I'm looking for the May highs right now, right? And that equates to probably about 4,100 on the SPX and maybe 20-ish on the VIX. But yeah, you could be looking at a higher number depending on where, if your scenario plays out. The reason why I think this is playing a specific role at this point is, number one, like, if we go back and we look at last week, right? I think it was last Friday, we had the employment report come out.
Yeah.
And if you remember, we had that really nasty sell-off in cash trading in the S&P. And that, correlated with this, very, very big rebound in USDCAD. Actually, it started almost 10 minutes before the actual sell-off in the cash market started. And what I think is driving this is some sort of short volatility dispersion trade. Where
which
essentially
means what? Too many people still selling volatility. They're short vol.
Yeah. So basically, what it means to me is that you have a lot of people who are going short or have been shorting index level S&P 500 volatility, and then hedging that by going long implied volatility of the basket of stocks that make up the top 50 in the index. And basically, that what we're seeing is, in this case, you have what looks like, short volatility on the S&P coming down, and you have volatility in the major stocks all moving up during that same period of time, heading into earnings. And you can see this in the one implied correlation index. This is basically it's an index that measures the implied correlation index of the top 50 components. And basically, when this is going down, it's an indication of stocks implied volatility in the S&P going opposite of that of the basket of stocks that are held within it. And this basket got down to basically the 2018 lows, which of course we know 2018, we had, two major risk off events that year. The first one came in late, early 2018 in that January timeframe. And then of course, the second one came in that fall. And here you can see that we got basically down to those levels. And so my thought process here is that this trade is in the process of unwinding. And this is going to basically, trigger the VIX moving back up and the S&P 500 moving down. And what I've have found particularly interesting, again, is this relationship between the Canadian dollar and the VIX. And basically what I've been doing is I've been using the Canadian dollar as a proxy to basically tell me the direction of where the VIX is going. And since I know where the VIX is going, I can then determine where the S&P 500 is going. And what I found particularly interesting yesterday was that we had a really bad 30-year auction.
Failed almost. A failed auction.
Yeah, almost failed. And what was interesting is that, the Fed is still doing QT, but that doesn't mean they're not still buying bonds, because they still have to, keep the balance sheet at only $95 billion a month. So they actually bought about 8 billion of those bonds yesterday in the 30-year. So it would have been a lot.
8 out of how much? What was that, 50%?
It was a third almost. Yeah,
okay.
It was like 8 out of 23, maybe a quarter of them.
So,
or a third rather. And so obviously it would have been a lot worse had they not been a buyer, right? And so this really, got the Canadian dollar moving higher. It got the dollar strengthening against the Japanese yen. It got the dollar really strengthening against the euro, and it got the dollar really strengthening against the pound. And what my next big view here is that you're going to see the dollar continue to move higher, probably back to this 103.5 to 104 region. And I think ultimately probably push even further than that. And that's really going to pressure financial conditions overall, make them tighter, which is going to basically result in the VIX index moving back up as this implied volatility, this short volatility dispersion trade unwinds, but also as a product of the dollar getting stronger. And that's going to bring us back to this region in here in the S&P and basically erase this whole AI stupidity that took place over the last couple of months.
NVIDIA rolling over in a pretty big way, and that was the poster child. Let me ask you this, Michael, and even the bulls are saying, yes, we can have a correction, maybe back to 42, 39, but it's going to be a great buying opportunity. So, I'm comfortable that people think it's just going to be a correction. I'm not doubting that they'll buy them there, but I am doubtful that that's going to be it. So, can you glean anything besides maybe just a moderate move in the VIX back to 20, 25, and I think you said S&P's what, 4,100?
4,100, yeah.
Yeah. So is that a break to buy in a bull market, or does this top have even more significance than that 8% pullback?
I think that's the really key question, right?
And so tell me, which one is it, so I could relax this weekend?
So I think that's going to be dependent on credit spreads.
Okay.
Because what we've seen during this period of time is that financial conditions have eased dramatically since March, when SVB collapsed. So the blue line being the National Financial Conditions Index, the white line being the CDX high yield CDIS spread index. And the way I've been thinking about this isn't so much in terms of S&P 500 in terms of stock prices, but I've been trying to think about the S&P 500 in terms of bond yields. And essentially what I've noticed is that the S&P 500 has been trading an awful lot like high yield credit. And here you can
HYG has it looks like a different chart compared to sovereigns TLT. Is that a
Right.
statement that people have more confidence being paid back in junk than being paid back in sovereigns?
Well, it would almost seem that way, but it could also just be a representation, though, more of that people just are very complacent too, right? That they
Okay.
don't really feel there's a risk to
Yeah.
owning junk, right? Not
Right.
necessarily that they feel more comfortable. And what you see here is the S&P 500 earnings yield has basically just been trading with high yield credit spreads. And so that's really going to be your clue, right? Because if we see credit spreads really start moving higher, that also means that the VIX index is going to be moving higher, because all these things are just overlaid on top of each other. You can see the relationships between
Yeah.
all of these things. They're all just the same
They're
instrument,
linked.
really.
Yeah.
Right. And so if we start seeing some sort of panic in credit spreads, and you start getting credit spreads back up to levels seen in March, or that's going to be your clue, because if credit spreads are still going higher once we get back to, let's say, March levels in the S&P 500, you know that the S&P is going to continue to go down.
So
Or
that's
you could,
3,800, the March levels.
well, March levels would be 3,800, but then of course you're talking about, higher prices, October levels, you're talking
Yeah.
3,600.
Yeah.
And what's interesting is what the market has done this entire time has basically collapsed the spread between stocks and real yields. And I think we've talked about this in the past, because we have here a chart of the NASDAQ 100 earnings yield. And on the bottom, we have a chart in the yellow of the 10-year real yield. And this chart is a representation of that spread. And what you can see here is that for 10 years, basically, we trade it within a very tight range. I mean, this is extremely tight, right? 4.425% spread. Now that spread is just 1.88%. It's equivalent to levels seen before the GFC, which could tell us that the market is just repricing for a higher rate environment, and perhaps this is all just normal, these current valuations. Or it could be telling us that the market has just really become too complacent, and that these valuations we're seeing in the market are just, too high and they need to come down.
Okay.
And another way to measure this is to take the QQQ and then overlay it with the TIP ETF. And if you adjust them for dividends,
What
and
a
then
divergence.
you overlay that chart, you have what looks here, again, going back to that same chart we just looked at, the same thing. 10 years of basically the things doing the same thing. And then this big divergence that's taken place now since March. May.
Okay,
this
March,
is March 31st, April, March, right? Hold on one second. My dogs want to go in.
Good boy. Good boy. Give him a milk bone.
Sorry.
Give him a milk bone. Before we continue.
Two golden retrievers.
Oh, beautiful.
They need more than milk bones. And you can see that something has changed, right? And so this is either an indication of, a market that's become extremely complacent, or has just decided that it's going to value things differently. Now, maybe there was some truth to that, because you had, this idea that AI was going to be, some sort of productivity game changer, right?
Right.
So far to this point, it doesn't sound like AI is going to be changing much of anything immediately. And if we look at global liquidity, which is also something that I've been following, which is basically all I'm taking here is the total assets of the Fed, less reverse repo activity, and the TGA, and we're basically reserve balances. And I'm adding it to the balance sheet of the BOJ, the PBOC, and the ECB, and I'm putting them into dollar form. And again, you can see that same divergence, almost exactly like what we saw in the TIP ETF.
Yeah.
And exactly starting at around the same time. So either something has dramatically changed with how the market is valuing things, or there's going to be a big reckoning coming, similar to what we saw when we diverged in 2018, and similar to what happened to when we diverged even in 2020. And that's really, I think the key question. And so, yeah, a pullback seems warranted. The question is does it stop at 3,900 or 3,800, or does it just keep going? And I think a lot of it is going to depend on some of those sentiment measures, like we were talking about with the credit spreads. I think those are what you're going to have to turn to at that point to see, on top of whether or not liquidity is continuing to drain.
Mike,
if you just
Mike, do you think we have a severe banking crisis that people are just whistling past the graveyard for? Because when you talk about yields and like the bonds going to new lows, that only exacerbates the duration trade that these banks ended up having to fail because of. And it's not just regionals. I mean, you look at Citibank, the money centers don't look great either. Is there something brewing there to stop, what's going to stop the capital flight out of banks?
Well, I mean, you're going to need to see rates on the back of the curve either continue to rise to offset some of that, or you're going to need to see rates on the front of the curve to come down. Either way, you're going to need the yield curve to steepen. I don't think it's 2008, obviously. We're not talking about, assets we don't know how to value here, or assets we're just writing down to zero. We're talking about, treasury risk and duration risk more than that, right? And the Fed seems to have at least, quelled the problem by creating that BTFD, what is it, the bank term lending facility, BTFL, LF, using its balance sheet.
So you're saying
what's interesting,
you're sanguine about it then?
I don't know. I wouldn't say I'm sanguine and not alert about it. I would say that I'm not viewing like a worst case scenario from it. I think there absolutely could be more bank failures, but I don't think it's going to be like credit crunch like we saw in 2008. What's happening in China is actually a lot more concerning to me with these property developers than what's happening here.
Okay, so we're still the cleanest dirty shirt.
Yeah, if you want to go back to 2011 terms, we're still the cleanest dirt. Because Asia's just been dead for sale every night, and this stuff out of China has been Country Garden and a couple of other ones. I mean, this is the Hang Seng Index, and you can see we've just been really underperforming. And another reason why I'm sort of thinking about this, AI trade quite a bit is what the signals you're getting out of Taiwan, because Taiwan, again, you want to talk about something maybe falling off a cliff. There's your Taiwan capitalization index, right? The big index over there. So it looks like it's ready to go too.
Looks like the Nikkei.
Yes, and the Nikkei was closed last night, so we didn't get that opportunity. But if you look at Kospi, if you look at the Kosdaq, I mean, look at the volatility you're seeing in this index, and then you row back in this
and the yuan getting ready to make new lows, continuing to devalue.
Correct. I mean, look at this trend line here.
Yeah.
You're talking about Asia, which appears to really be materially weakened. You had the CSI 300 down another 2% last night. New yuan loans are down. I mean, so Asia's really more concerning to me at this point than the US is.
Okay.
And you don't really see enough people paying attention to Asia. But again, Taiwan Semi is the guys who are making all this stuff for NVIDIA that's supposed to be changing the world. And Taiwan Semi doesn't really seem to be doing very well. And when you look at
NVIDIA, what do you think of NVIDIA and Apple?
And here you can see how Taiwan Semi almost leads the S&P 500. Interestingly, about NVIDIA, I read a story in the FT talking about, well, not the FT version, but the Reuters version, which summarized the FT version, talking about how these Chinese internet firms, Baidu, Tencent, ByteDance all placed about $5 billion worth of orders for these new A800 GPU units from NVIDIA, which are supposed to be like the, China-made version where they're, don't have all the restrictions on them. And apparently these orders were placed, ahead of expectations of these new rules that, restrictions the US government put in place. And so I read that story and I did a little more digging. I went to Digitimes, which is the, sort of Asia version of, anything you want to know about anything going on in the chip world. And they wrote a story right after NVIDIA made that huge guidance call, noting that there had been a flurry of orders coming into NVIDIA from Chinese internet companies. And then I had read another story back at the beginning of May talking about how these new A800 GPU units just hit the Chinese market. So I was like, oh, gee, they've guided $4 billion higher than what the street was looking for. This just happens to be a $5 billion order that came in like last minute. I'm like, now it made me think, like, is this NVIDIA quarter that they guided to a one-time event? Or is it going to be, that NVIDIA is now going to start doing 11 or $12 billion a quarter? The street appears to be pricing it as if this is a new level for NVIDIA, this $40 billion run rate. But when you read the news, it almost reads as if this is only a one-time event and that these guys were trying to front run new restrictions that may have been coming down the road. And that may be why the stock is sort of looking the way it is. If indeed the street is starting to think that maybe this is just a one-time front run, and that this demand isn't really as significant as everyone thinks it is. But again, I don't obviously know. I'm just relaying sort of what I've been reading about.
Do you have a view on Apple? Because technically it was in this uptrend that it only took one bad day to damage it. And actually
I've owned Apple
50-day. Huh?
Yeah. For full disclosure, I own Apple. I've owned it for many years. I bought it somewhere in 2018-ish or so. Maybe
what do you think here?
So Apple, actually, this is the most I recently took
the same thing.
I recently took, some gains up in this level off the table because I've owned this forever. And I was like, I'm not going to watch this and go back to 120 and not have taken anything. This is the most
That's where it's going, isn't it? That's where it's going, isn't it?
Could be. This looks like the most manufactured move higher I've ever seen.
I mean, I was being squeezed all the way up. I started shorting it at 70, and then
you've been doing this a long time. How many times have you ever seen a chart like this?
You don't. It gapped the 50-day moving average. That's and all week, all it's been able to do is hold.
Right, because it's probably going to go lower still.
Right.
And this goes back to what we were talking about. This is what goes back to what we were talking about in the top of the beginning of the show, which was the short volatility dispersion trade. Apple is the key to that trade working because it's the largest market cap stock, right? And so if Apple goes, then everything is going to start to go. And
do you think it was coincidence they rebalanced the NASDAQ 100 before this event?
I don't know if it was coincidence or not. I think it needed to be done.
It was smart.
I think it was, but at the same time, like I think that again, I don't think I don't think it was based off of this idea that, they were trying to get in front of, the market unwinding or something. I just think that they should have done it probably a long time ago. And they finally did it when the weightings really got to be too obscene. But I generally think, if you start going through these charts, and I own a lot of these, FANG plus names, Apple being one, but Microsoft being another, again, you can see it's the same, look. I mean, it's just sitting there like waiting to take that next leg and then maybe fill the gap down to 275. Amazon's another one I own, and right here you're right up towards the upper end of the range, and Google's another one that I've owned a long time. But again, these don't look as bad as, let's say, Apple or Microsoft. But then you look at Meta, again, another manufactured move higher. I mean, in sequences almost, right? With all these breakaway gaps. Here's your trend line, right? And it's not going to take much at this point. Here's your divergence on the RSI.
Yeah. Okay.
So, you know, if one of these start to go, NVIDIA, you know, if you look at AMD, same thing, just sitting there.
Looks like 80's coming.
I mean, you're a little more. Yes, certainly could be if this is just, you know, gonna wash out, right?
Yeah.
You can see the same thing in the SMH. So it looks like a rising. I call these a rising flag. I don't know what the exact technical term is, but you get this big pole, and then you get, instead of the typical flag that slants down, they go up, and they're usually, in my experience, they've been pretty bearish in the past, which sort of means maybe you're going back to 122. Which is, again, the May 15th level, which corresponds with, you know, this level, you know, May 15th here is around 4,100. You know, May 15th on the Qs is around 326, you know, back to where this all started.
Yeah, that's where we're going. Yeah.
That's where I think we're going.
Michael, what a great presentation. And you know what? You're a real hard worker.
Thanks.
You know, the research you do, and, you know, you see a thread and you follow it up till you know, have some answers. So you're one of the, you know, real good minds out there when it comes to dissecting markets. Best way for people to get to know you better, besides your Twitter handle at Michael Mott, what is it? Michael Mott CM. Yes.
You can just follow me on Seeking Alpha. I do a lot of stuff there. Most of my, you know, I wrote about all this stuff probably over the last 6 weeks or so. I've been writing about it. I just publish under the Mott Capital Management handle there. And I also have a Substack on that I also do too, which is I put out a weekly commentary on, which is for free. I usually post that to Twitter as well. So basically everything sort of revolves around Twitter as my place to, you know, put out content, and then it just separates from there. But Twitter is probably the easiest way to get everything in one place.
All right, Michael. Well, have a great weekend. Thank you for coming here and edifying the community with your great work.
Thank you. Looking forward to coming back again. I always love doing these with you.
Okay, we'll I'll get in touch with you, and have a great rest of the summer, and we'll be talking in the fall.
Okay,
Twitter
sounds
handle,
good, Dale.
You want to post your Twitter handle in here?
Where do I do it? In the chat room?
Yeah, you could just post it in there.
Okay.
Turlin, it's doing. Kevin's thanking you. Simon liked it. A lot of people. 3,800. You don't. Yeah. So.
Okay.
All right, guys. All right. Thank you, Michael.
Good luck today.
Good hunting, buddy. Appreciate you being here. Adios.
Thank you.
All right, everyone. That's a wrap for the week. We put it all out there on the floor for you. Brought a lot of great outside guests, you know, Peter, Michael. So, you know, you like what we're doing here in Face, the way to say thank you is to do something for yourself and subscribe. Or try the TFP. They've changed some rules, I believe, that it doesn't make it easy, but maybe a bit easier. So check that out. Have a great weekend, everyone. Don't just count your pips, count your blessings. Recharge over the weekend. Get your battle plan together for next week. It's going to be an exciting 6 weeks into the end of summer. You're very welcome, Ingmar. See you guys who joined the team in 13 minutes for the morning edge. You're very welcome, Barry. See you guys and ladies. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.